Perfect. Hey, everybody. Good morning. It's Mike, your co-host of Saturday Morning Multifamily Unplugged. And I am joined this morning by my co-host, Moose. Moose, what's up?
How you doing, Mike? Good to see you. We took a little break over the holiday, but good to be back.
Yeah, boy, we took a week off. And, it kind of seems sometimes when you take that week off that it's a long period of time. And, it's good to be back, though. Good to be back. Hey, listen, if you're joining us on Clubhouse this morning, we're glad that you're here. Just know that we're live. There will be no questions or conversation on Clubhouse this morning. We're going to do a deep dive into multifamily this morning. We got a couple of great guests, Carl. I think that you'll be surprised, and I'm going to be surprised too, I think, at some of the conversation. So stay tuned in. We're live on Facebook. We're live on Zoom. We're here every Saturday morning at 10 a.m. Central Time. So if you're a follower, welcome back. If you're new, thanks for being here. Love that you're here, and would love to answer any questions for you. Also, I just ask every week that you would go to social media, wherever you hang out, wherever you get your social media fix, you'll find us. Personally as well as business wise on every platform. So go subscribe to us on YouTube, My Core Intentions, and you'll find our Multifamily Unplugged playlist there. Go subscribe to us on Instagram, follow us, like us, love us, tune in, because you will get relevant content as often as we are around. And there's a lot of pop-up stuff that we do, whether it be on Clubhouse or on Facebook. We're going to be switching platforms, Carl. Maybe we'll talk about that a little more at the end of the show. But, let me, anything you want to chime in here quick this morning?
No, I think we got, the four of us are going to have some great conversations. So let's have at it. Let's get to it.
Yeah. So our guests this morning, a couple of Chicago multifamily guys. And I have to tell you, Carl and I met these guys at a networking event. We were just trying to figure it out back in October, maybe. And, it was interesting. We were like, wow, multifamily guys in Chicago. So it's kind of interesting because I have a tendency to do a lot of stuff out of state and around the country. And I haven't been a real advocate for Chicago, but I'm starting to get an affinity for it. I heard one of the senior execs from Goldman Sachs give a report a couple weeks ago about Chicago and the Chicago market. And I thought, maybe we should give this place a second look. So we're going to talk about that a little bit today. We're going to talk about what they do, who they are. I want to welcome Jim Marzullo and Tim Coleman to the show this morning. Welcome, guys. Jim, if you want to jump in and introduce yourself, tell people who you are, how you got in this crazy business, then turn it over to Tim. That'd be great.
Yeah. Thank you, Mike and Moose. Thanks for having us on today. It's a pleasure to be here with you guys. So I'm Jim Marzullo with 10 West Real Estate Group. We are real estate investors, as Mike said, based here in Chicago, primarily focused on the west suburbs of Chicago. I'll give you, the 30-second background, and we can dive deeper into it. But I am not a traditionally trained real estate guy. I built the first half of my career in technology. I ran tech startup businesses. And then about 10 years ago, I got out of that and I started building single family homes in the west suburbs of Chicago under our sister company named 10 West Development. And my real passion was for multifamily, but I had an opportunity to start building single family homes. And then about 3.5 years ago, I bought my first multifamily property in Glen Ellen, kind of fell in love with the business. And so the story goes, we've been building a portfolio ever since then.
Hey, isn't it interesting? I like what you said about fell in love with the business. They always say that if you're passionate about what you like to do and you follow your passion, that you're going to be successful, right?
Yeah.
And, multifamily is an easy space to fall in love with.
Yeah.
And the thing I like about it is it's so fluid. You keep learning. There's always something you can learn. There's somebody smarter than you. I always say, if you're the smartest guy in the room, you need to find a new room to hang out in. So
right.
Glad you guys are here this morning.
Yeah. So, well, thanks for having us.
Hey, Tim, you want to take it over for a minute?
Yeah, sure. No, I appreciate Moose, Mike, getting us in there. I apologize about the not being on, seeing my beautiful face, but I think I got a voice for radio instead, so maybe that's better. But yeah, so I started my career, actually didn't even start in the real estate business. I was supposed to be a high school history teacher. And when I was going to school, I actually bought my first house. I was 20 years old, and pretty much it was a fix and flip. Got into it, wasn't licensed. Actually got kind of taken advantage on some of these investors that were selling this stuff to me. Realized these things were overpriced, overappraised. Got into a big situation in there. Started out, I had about 6 houses that I had in there. Then got into school, realized, hey, you know what? I should get my real estate license because of what happened with me. So then I got licensed in 2003. Mainly started on the residential side on brokerage, and then grew out of a long time real estate company here in Chicago, and realized, hey, I was 21 years old. I want to go out, do my own deal. So I actually opened up my own real estate firm, and we grew that from me, myself, and I to, I think there was 18 agents at the time. Went out and then realized, hey, I want to get into commercial. So then got into commercial and into development, did some small plate industrial stuff, got into that, actually opened up a national franchise, doing commercial. We did all that, did everything from, 07, seeing the great times, all the way to the bad times in, 9, 10, 11, and then been doing it ever since. I personally own my own portfolio as well. That we have, and Jim and I partnered up, and we've been doing this ever since. So it's it's something I've loved to do. It is passionate about something once you're in it, how much you love it. Like I said, I've been doing this 18 years now, and I'm not that old. So
Yeah, nice, good for you guys. Hey, how'd you guys meet?
So we actually met at a
course.
golf outing, and if anyone's ever seen me golf, it's a miracle that Tim would want to partner with me after watching me golf. But we met at a golf course, and we just hit it off. We were both similar personalities, similar business goals. And Tim, how long did we talk about it before we actually ended up partnering? 2 years, a year and a half, something like that, before we decided
it was close to at least 2 years. Yeah, because I actually was working with another company before I opened up mine in between that. And Jim's on the same page. Believe me, I'm no a golfer either. So I think it was nice that we got carded together and, kind of talked a little bit. And it's good.
Isn't it funny how things like that work? Mike, I remember when we went out to that event out at Emmett's, you and I were thinking about not even driving out there, right? And we met Jim, we met Tim. I met a guy named Chester out there. I met a couple of other people. So, it's taking that action, and just doing, sometimes you don't feel like doing something, you do it, or, people think, there's circumstance or there's, there's no accidents, right? There's no accidents that you and Tim, Jim, you guys met and now you're working together. And then the other thing I just want to point out before we get deeper into the conversation is, a couple things, both you kind of came from, like Mike and myself, came from backgrounds not around real estate. And here you are, fast forward, 15, 20 years later, you're in real estate and you're doing well. And, I love the fact, Tim, that you got started in college. You know what I mean? You were going to be a teacher, and you got the real estate bug, and you did it as a young guy. And, for people that are listening, I really want you to understand that you can get into real estate at any point. You don't have to come from a boatload of money. You don't have to come from a family that's done real estate. If you have a desire to do it and you partner up with the right people and you get the right mentoring and training, you can do it. So I just wanted to comment on that before we jump any deeper.
Yeah, that was great. Good stuff, Carl. And, I think that if the 4 of us went golfing, Jim, you and I probably could ride together, and we'll just, we'll meet them down the road, I'm sure.
Yeah, exactly. Yeah.
So, my son's an avid golfer, which just, it's terrible. He puts me to shame. He's got, he's 16. He's got like a 325-yard drive. So
it takes me 3 strokes to get there.
Yeah. So listen, Uh, talk to us. Hey, you guys say I like Tim. He's going to be a high school history teacher, right? If you think about inland real estate, and we all know who inland is. If
Yeah.
you think about inland real estate, the inland was the they started out as four high school teachers, right?
Yeah.
And today they're the largest REIT in the world. They're in 80 countries in every asset class. So you never know where things go for people depending on desire and what you want to accomplish. Hey, so talk to us about the first multifamily deal you guys did.
Yeah. I'll pick up on it's actually an interesting inland tie-in too. So I was building single family houses. We were doing 5, 6, 7 a year at that time in the west suburbs of Chicago. I grew up in the Wheaton Glen Ellen area. And actually, the deal was from a friend of mine at Inland. It was a 20-unit apartment building in downtown Glen Ellen, which I was very familiar with. And obviously, way too small for anybody at Inland. So it kind of filtered down to me through a couple friends. And it was like, hey, this may be a perfect deal for you. Here's a plus location, but this is 100-year-old building that's been neglected for 50, 60 years. You could put your construction resources to work, and you can go to now, mind you, I knew nothing about how to analyze a property. No, my metric at that time was, let's buy it here and sell it here and make some money on it, right? And so I personally naively went into that, right? And I bought it, and we kind of approached it through natural attrition. So as people's leases ended, I went in and I got rehabbed all the units, and then did the common areas, and then we released it. And my intention really was to sell it at the end of the day. And then again, like taking a step back and looking at it, and then getting a little more savvy with the numbers and understanding how this all works, I looked at it and I said, wow, this is a really interesting business. I love this passive cash flow. I like what I was able to do here. I didn't know it at the time, but I was able to kind of force this appreciation and really change the economics of the building by what I did. Again, dumb luck, kind of backed into it, but then looked at it and said, hey, I like this, and I think I'm going to keep it. And then as the story goes, started my own property management company, sort of started putting the pieces together around that. And then shortly after that, bought another deal in Elmhurst.
Isn't that interesting? I always give credit, because I did the same thing, to the guy who just says, hey, I don't know how to do this, but I'm going to go do it.
Yeah.
Right. And I have a couple coaching clients like that right now. They're like, I don't know how to do this, but I'm just going to go do it. So keep stretching me. Right. And
Yeah.
that's the one thing about coaching that I like. I always had a coach who said, hey, just go do it. Just go do it. Just go do it. And then held me accountable to those little steps along the way. And that's what I do with my coaching clients now. I got a couple of guys that are hungry, hungry, hungry.
Yeah.
And, because of their hunger, it just causes them, hey, I don't know if you see the movie Rudy, right?
Yeah.
There's a great example of hunger, right?
Yeah. Yeah.
Hey, Tim, you want to chime in?
Yeah, no, going back on that inland deal, essentially same thing. I actually got my CPM designation, got into property management going through inland. And really all it is you look at it, it's exactly like what you said, Mike. It's like, if you have an interest in it, it's just like, you put it into anything, not even just real estate, right? Like my son plays hockey. He's interested in hockey. He's going to do whatever he can to make hockey, right? If you're interested in it, find the people who are going to make you better. Such a small world. What Moose and I, we found out about with my son's coach and stuff like that, all in the same thing, small world. But yeah, have the passion, have the interest. And like you said, follow like-minded people. And again, that's where I think, Jim and I are always good at each other. It's kind of like, you have to have that yin and yang. You have to have that like personality. You have to have that likeness of where are we going? Where's that accountability? What are we looking for? And again, it's a risky business, but it definitely pays off. And if you follow the right people and take the chance, I tell my kids all the time, you got one life to live, do it well, and just try out. You know what I mean? So I think, again, with the inland thing, it's huge. Those guys literally took their retirement essentially of being a teacher, and went out and started buying multifamily. And now they're one of the biggest, REITs in the world.
Yeah.
Yeah. I had a coach in college who always used to say, make errors of commission as opposed to errors of omission, right? In other words, commit to something, take action, do something. And in Think and Grow Rich, Napoleon Hill talks about it. He said it's taking action is always better than inaction, because even if the action is not the correct action, you're going to learn from it, right? As opposed to doing nothing. So, and following your passion, and just really stepping into what it is that you enjoy doing. And, it's so funny, Jim, because the first building I bought, I was working for a bank. I bought an 18-unit building. I had no idea what I was doing, but I said, I want, it's ridiculous that I've been in this business for so long and I don't own any multifamily. I mean, I was financing $100 million portfolios for people, and they look at me and go, you don't own any property, right? So kind of the same thing. And I just, I didn't really know what I was doing, but I got into it, and I'm glad I did. So now,
Yeah.
what was the first deal that you and Tim did together? I'm curious about that.
So, Tim, you want to jump in? We kind of merged portfolios. So we partnered in March of this year. So we merged portfolios. We were kind of on these individual paths going down. And since March, as you can imagine, we've underwritten probably 50, 60 deals, but haven't yet bought one together, simply because since March of this year till now, it hasn't looked it hasn't looked good, So I think that's the biggest challenge for us right now is, combining portfolios, managing them all, because we provide brokerage and property management services together. And so we kind of merge those two entities together. But that is our biggest challenge. And I am, it's funny, I was listening to one of your podcasts earlier, and Mike, you asked people that, one word that describes yourself. And, for me, and Tim can attest to this, it's operational, right? Like, I wake up in the morning, how can I streamline things? How can I, and so we have very intentional goals for ourselves, right? So every Monday and Tuesday when we meet with a partner, and our third partner is my wife, Christine, we literally have, metrics. How many deals did you underwrite? How many offers have you written? And we go through the motions, even though, these deals are not out there right now. But we run through this through these steps of being prepared to rip contracts when they become available. But it's tough right now. I would say that's our biggest challenge right now, is trying to find that next deal. We had a great one under contract in DuPage County, 90 units. That was going to be our first deal together. But I'm a big believer in due diligence. I don't shy away from value add, because that's where I've actually been most successful. But Tim and I had to make a tough decision on this deal, even though we were anxious to do something. Sometimes the deals you say no to are even better than the ones you say yes to. And we just, after inspections, we really thought that it was beyond issues. We were worried about the day one liability of owning this property. And we decided that, we're going to have to push off this first deal to another time. So I don't know, Tim, if you have anything to add to that.
Let me just jump in. Let me just jump in here real quick. You underwrote 90 deals, all in the Chicagoland market, all DuPage County or all over?
No.
So we underwrite.
No, all over.
Yeah,
Okay.
We underwrite about 15 deals a week. And I would say our focus is DuPage County and suburban Cook. That's really where my portfolio exists today. But we have, through exhausting that a little bit, we've moved up into, I have a second home in Wisconsin. So we started looking at the suburbs of Milwaukee. I have a son that goes to college in Indiana. So we started to look in Northwest Indiana, Indianapolis. He's down in Bloomington. And Tim has family in Florida. So we've even started to underwrite some deals over there. But to no avail, or at least at this point, nothing that we felt was worth writing an offer on.
So did you guys look at that? And I'm just going to throw a couple deals out, because I've looked at a couple here in the Chicago market. Did you look at that deal up in Mount Prospect? It was 42 units earlier this year. It was probably
I think we have. Yeah, I think one of us underwrote a Mount Prospect deal in the last couple of weeks. Yes.
This was earlier this year. It was up in it was probably springtime earlier
Okay.
this year.
Yeah.
And that one, and then there was another deal that we looked at out in Harvard, was like 106 units or 108, 96 units, something like that out in Harvard. Do you remember looking at that one?
I think that's somewhere in my underwriting as well.
And I'm just wondering what maybe about those deals, because I'm thinking back about that Mount Prospect deal now, especially after I heard the this senior exec from Goldman Sachs get on this webcast last month, thinking, man, I should have bought that Mount Prospect deal.
Yeah.
You know?
So I'll back up a little bit and say, like, I had a thesis, and I developed this before the pandemic hit and before work from home was it. So my thesis was that these suburban downtown areas were becoming really viable. Glen Ellen, Naperville, LaGrange. I had this theory that you don't have to live in the city anymore. These feeder cities are vibrant. They're on the tracks. People are going to start moving out of the city and living there. Now, pandemic hits and all this other stuff, and people, all of a sudden that thesis is everybody's thesis, right? But that was our original strategy. And so going back to your question about, what didn't I like about the deals, or what didn't I, why didn't I transact on some of those? In the past year, I did about 100 apartment remodels. So I've been really, face down in stabilizing my portfolio and getting everything turned over. And in that time, the market has really changed, right? So we were, and I'll just throw loosely some numbers, we were buying things at a 6% cap rate, value add deals, right? Then I was going in there, adding value, releasing, and on the back end, these deals were pushing up at double-digit cap rates, which is unheard of now, right? And so you can imagine my surprise. I go face down for a year. Those are the metrics that I'm used to seeing. Then I pull up and I'm underwriting everything, and it's, and we have our own underwriting, we have our own metrics. So, I always look at a broker portfolio and say, I've got my own, right? Give me the income, I've got my own for expenses. And Tim, you can chime in on this too. We're seeing most deals come through at a 4.5 cap right now. And I just can't, I still cannot wrap my head around that, right? I'm still not there that's where the market is right now.
Yeah, and I don't mean to keep cutting you guys off, but we were talking before the show about this deal in northern DuPage County, 70 unit fractured condo deal, and it's a Class A asset. It'd be a trophy asset to hold on to, right, and to sit in for a few years. The cap rate going in on the things like a 3.75. It's like, really? Where's the market going? So how are you guys underwriting? And let me just reset the room real quick before I ask this question. Hey, everybody, welcome. It's Saturday Morning Multifamily Unplugged. If you are joining us live on Clubhouse, we are absolutely glad you're here. No conversation on Clubhouse. If you do have a question, you do have a comment, you can jump on Facebook Live, put a remark or a comment in the chat. Please communicate with us. Let us know that you're here. Jeff, good morning. Larry, good morning. Glad you guys are here. Melissa, good to see you out on Clubhouse. Hey, if you want to join us on Zoom, you can click on the link, join us on Zoom. But we are here every Saturday morning, 10 o'clock Central Time. And I will just say that we got a great show this morning. And Carl, you mentioned earlier that we met Jim and Tim at Emmett's. I had lunch with Michael. Michael's going to be on the show here in the right after the first of the year. But we have two other people from that event that'll be on the show here in the next couple of weeks. So we did meet some really good, strong people out there at that event. So let me go back to my question, if I can.
Sure.
And my question is, how are you guys underwriting? So, we all jumped into the business years ago, said, hey, I love this. I'm going to go figure it out. I'm going to go do it. I crashed and burned on my first deal. It was like, I learned all this stuff, but today I underwrite a hell of a lot different than I did 10 years ago.
Yeah.
So talk about that. Talk about how you underwrite today versus before. Cap rates today are at 4 and they were 6 when a year ago.
Yeah. So as I mentioned, no background in real estate investing when I bought my first building. So a lot of this was just back of the envelope math, right? So, it was very much like, okay, so income is X. I believe expenses to be roughly 48%. So that leaves me 52% for my NOI, and back that into a cap rate. Do I like the deal? Right. I mean, that was literally kind of how I bought my first couple properties. And now there was a larger, there was more room for error back in those days, right? So if you're off a little bit, it didn't matter. Now, because I think everything's compressed, right? I think margins have compressed so much, you have to be a little bit more scientific about it. Tim can attest to the spreadsheet. I'm a spreadsheet guy, so I love it, and it's gotten a lot more sophisticated, right? And so, I would say from an underwriting perspective, we really try to get to the source of the income. We try to collect data on income, make sure we have a good, true sense of income. Now, we have amassed, my portfolio is in DuPage County. We've got 8 properties, 125 units, and we've got some really good data, operating data of our own that I didn't necessarily have when I was first buying properties, right? So I can go back and I can look at properties that are similar and say, what am I spending on water? What am I spending on electric? I have a really good barometer for those expenses. So now I take the stated income, I take what I know operating expenses to be, and I pump it through underwriting. And then, now we actually take that down through a syndicated model where we say, we look at something and we say, back of the envelope, is this something we want to analyze? Okay, maybe it passes that first one. Let's take it through some really detailed stuff with some actual expenses. All right, did it pass that? Now let's push it through a syndicated model and say, is this a deal that we could go out and syndicate, right? And so, Tim, I don't have anything to add to that, but it's gotten quite a bit more sophisticated over time.
Yeah, for sure. I see it more as like exactly like Jim's saying. So especially now, there used to be so much more, meat on the bone essentially than what was there today. When you're seeing, Mike, like you're saying, stuff going off at a 3.5 cap rate, I mean, you got to look at that, because some of these people are, that might be listening in, might want to try and leverage debt. And if you leverage debt on a 3.25 cap rate, it's risky, I think you've got to look at it. The fact is now exactly what Jim's saying. When you have a property and you own it and you know what those expenses are, so you could sit there and say, hey, I own a 1970s California style building. These are issues that I know I have with them all the time. And tenants are paying these utilities. Well, I could factor that into this. You have a lot more data to analyze that. So when the broker puts something into it, if it's a broker, led deal, you look at that and you say, yeah, you've got X for this, but I'm underwriting it at this because I truly know what that operating expense is going to be. I'm not going off the broker's numbers. So it definitely is an advantage of already owning property, where some of the, listeners in here might not have that advantage of it, but it definitely does come into play, especially now. Now, going back, Mike, like you're saying, like, where are we looking at some of these deals and this and that? We're in a market, hot market. I've been doing this since 2003. Like I said, you're going to see it's ebbs and flows. And right now you got to analyze every single deal and really, really look at it.
Yeah. So, here's one thing I know. Proverbs says that a wise man seeks much counsel. And by us being in this conversation and being in these conversations with people every day, I think it makes us wiser to understand the fundamentals. I think the fundamentals are screwed up today, to be honest with you. When I think back to 2007, 2008, you guys kind of know my story. I got in a little bit of trouble. 2007, 2008, the fundamentals came off the rail. And because they came off the rail, so did a lot of people. And so I see a lot of that same type of thing happening today. So it's walk cautiously. Like,
Yep.
You're talking about leverage, Tim, and that leverage is like, it's a scary place to be sometimes. I'm underwriting deals today at 65% LTV. I got a friend who's been in the business for years. They got $500 million under management and have another $500 million under contract right now to close on. And he's been in the business a long time. They're writing deals. They have equity coming to deals that is willing to take a 5% just to satisfy the money that they're putting in there. and they're writing deals at 50% LTV and paying a 5% preferred. That's it. So, where's this market going to go?
That's a great question. And I think that, that I often say to myself is this a rising tide or a bubble? Right. We've all been in places where we've passed on a deal. I was just driving past a deal in Elmhurst that, 2 years ago, I lost that deal by 50K. And at that time I said to myself, oh my God, this is so overpriced. I can't, but then you look at it and you say, well, it was a little bit of a rising tide. Right. And I think that deal maybe still made sense. I'm not so sure. That philosophy, I don't know anymore. Right. And when I look at these deals now, I say maybe we're sitting on a bit of a bubble here, right? I don't think this is a rising tide. I think that this is out of whack, as you said.
Hey, listen, I have one of my coaching clients that's online this morning, and
Yeah,
he put a little something in the chat. Let me just
yeah,
read this,
sure.
and I want to see how you guys address this. He says, lower cap rates is one of the questions / concerns. I forgot to bring it up on our last coaching call. Mike, 6 cap to a 4 cap can be paralyzing. How do you guys talk about that?
Yeah, I mean that. Go ahead, Jim.
Yeah, no, go ahead. You can tackle that.
Yeah, I mean with that cap rate, so everybody's looking at for cap rates, and that's something you have to think of. Like, for example, Jim and I are more buy and hold, right? So we're looking at it as buy the property, make some renovations, value add if we can, hold it. We want this to be, generational wealth for our kids and stuff like that. If you're looking at flipping it, cap rate is huge, right? Because, I mean, that is going to make a big difference between the 4 and the 6 cap. So what I would say is like that coaching client that you have there, it is paralyzing, right? And if you're not comfortable with going at that lower cap, which is obviously driving up a higher price on the property, you just don't do the deal. And I think Jim and I and Christine, we've all talked about this in our partner meetings. You're seeing a lot of institutional money out there right now, which I think is a big player in the market as well.
Yeah. And that's pushing the market, I think, is that institutional money, because when you look at the hedge funds and the teacher pension funds right now, they need a place to put their money. The insurance annuities need a place to put their money just to clip a coupon. And that's where you used to be able to find the safety in the A-class deals. But now everything is so compressed, so close that you could go in any one of those classes, A, B, especially upper C even. In a lot of cases, you're going to see a lot of cash flow.
Hey, I want to make a comment real quick. I want to make a comment. For some of the listeners out there that may not understand, just real quickly on cap rate, and unless Jim or Tim, you want to pick this up, just a real quick overview, 30-second overview of what cap rate is, why a low cap rate's good for a seller, why a high cap rate's better for a buyer. If one of you guys want to pick up that, just to educate our folks that are less familiar with that, or Mike, if you want to grab it, or.
No, I mean, I'll give a high level. I mean, you have the formula in the chat there for everybody to see, right? And so generally, a lower cap rate is great for a seller because they're getting a higher price, right, for their property. A lower cap rate is not good for a buyer because they're getting less of a return, right, on it. So cap rate is this sort of, there's so many metrics, right? But cap rate is sort of this directional metric that we use. And I would say it's like that entry level metric, right? Because there's so many more deeper ones you can analyze. But that is sort of that litmus test of, where is this property, right, on for an investor.
So let me just, you guys, a bunch of people have jumped on Facebook and Clubhouse here in the last few minutes. Let me just reset this really quick. Hey, everybody, welcome. It's Saturday morning, Multifamily Unplugged. We're here every Saturday morning, 10 o'clock Central Time. If you're joining us on Clubhouse, it's listen only this morning. We're glad you're here. We've got a couple of great guests this morning. We're digging deep into multifamily. If you do have a question, if you do have a comment, you could jump over to Facebook Live, put it in the chat in Facebook. If you're on Facebook, say hello. We'd love to hear from you. Nolan's out there, Jeff's out there, Larry's out there, Mark's out there. Good to see you guys this morning, whoever else. And, we're here with Jim and Tim and me and Moose just bringing the show again. Hey, so let's talk about markets, right? So one of the big things is market fundamentals. So I got a buddy, he pays a lot of money every year for research. He sent me a report. I asked him earlier this week, I said, listen, I'm looking at this asset in Chicago. I said, can I get a report? He sends me a report um, about the markets. And the only market in Illinois that's anywhere close to the national average is northern DuPage County. Isn't that funny?
Yeah.
So, northern DuPage County, everything else is below the national average in rent growth. Now, if we look at the national average in rent growth and we say that it is 4% right now, because it's like 3.7 or 3.69, something like that nationally. I'm in Florida. I'm heavy in Tampa, South Central Florida. And what we're doing there is we're seeing stuff that, we're underwriting things today at 5% for the next couple of years. But the rent projections are 15% this year, 13% next year, and then they're going to back off. I think we have an 18-month window right now. But when you're in a market like northern DuPage County, Chicago, where we're below or right at rent, national rent growth, where's it going to go? And what's the backstop,
Mhm.
right?
Mhm.
How do you protect yourself from a fallout?
Mhm.
Well, one thing that I would say is again, living in DuPage County essentially and seeing it, we're in a market, one of the most densely populated cities in the country, right? So it's not like you're in a Dallas or an Austin or a Vegas where you have land to grow and development's going to go outside and things like that. We're in such a densely populated area that there is no land to look at development and construction costs and all that kind of stuff. Again, my background in development comes into play on this. So I still think there's going to be a driving force of, we're obviously in an economy where people want to work and people don't want to work, but there's always going to be a need for housing. And in the market that is now, especially in the Chicagoland area, it's so dense. It's not like I said, even Tampa is not as dense as what, you still got Tampa, St. Pete, Clearwater, Sarasota going further south. But I just think we're really in a truly densely populated area that you're still going to have that driving force.
Okay. Jim, any comments on that?
Yeah, I think rent, so my perspective is a little maybe different. So I think, traditionally, we always try to move rents, 3% annually, right? Is kind of where I guess like the standard has been. I think that COVID, eviction moratoriums, things like that, over the last couple of years when we looked at our tenant base, we've said we rather have good paying tenants in place than a bunch of potential evictions on our hands. So we were very sensitive with the way that we handled rent increases with our tenants. I also think too, we came to market with newly renovated units that we were able to set the base rent, right? And so it might be different from somebody who buys a building and wants to move rents along or figure out how to do it. We renovated and came to market at, where we wanted to be. So we were pretty happy out of the gate. It's an interesting thing. I mean, I don't know where it goes. This is one of those questions where nobody knows exactly where this lands or how this ends. But for us internally, we've been pretty flat, I think, over the last couple of years with rent to keep good tenants in place. But now we're starting to move that along again.
So what's your math today, or what's your formula today on your terminal cap rates? So if you're going in today at a 4.75 or a 4.5, obviously we know there's going to be continual compression a little bit, in this market, what's your terminal cap rate coming out in 6-7 years?
So as buy and hold guys, as Tim mentioned, I think our strategy is buy and hold and generational wealth. And I don't necessarily think about, I'm not a guy that's thinking about a 5-year sale or something like that. So I don't focus on it tremendously. where are, if the question is, where do I think cap rates will be in 5, 6, 7 years? I don't know. I mean, I guess as I think that interest rates go up, I think that cap rates, go up as well. I don't know about the next 12 months, but I think in a 5, 7 year period.
Got an opinion on other asset classes right now?
So Tim is much better versed at this. I love multifamily residential. Picking up on something that Tim said, people always need a place to live. I think that even became heightened during the pandemic when we were working from home and our home was our home and our office. The rising cost of construction and building and buying, I honestly am very bullish on residential multifamily. But Tim, you like other asset classes, so I'll let you talk about that.
Yeah. So Mike, just to get on that one, so I've done in my career, I've done anything from a small storefront lease to a 180 room hotel. So I've done retail, office, industrial, hospitality, vacant land. I've seen it all, self-storage, everything. Right now, asset class that you're seeing, obviously that, and everybody sees it, office, that it's hurting like crazy because of COVID. But, again, you have leases in place. So, I mean, there's still value into that. Right now, industrial is, especially by us, and I've seen it across the country, industrial is just insane right now. I mean, I look at a building that we looked at probably 6 years ago. They were getting $5-6 a square foot on some of this industrial stuff. They're getting $12-13 a square foot in some of these places. It's crazy. Logistics companies, anything with trucking, to do with trucking, anything like that is huge. I mean, you see Amazon's, creating a huge push with it. Even your small, like your small 5 to 15,000 square foot user in the industrial space, nowhere to be found. No, so much there's no inventory for it. You're seeing the big, 200 to 1 million square feet going up. It's gonna be filled, and it is what it is. But that's an asset class that it's crazy right now. Retail, I think 4 or 5 years ago, everybody would have said, oh, it's just it's a dying industry. I don't see it. I think it's still, people still want that touch and feel. Everybody's buying on Amazon and all that, but I still think there's people that are still looking for that. I think I just saw like a thing on Bloomberg or something like that said Thanksgiving, Black Friday, a lot of people shopped in store rather than I don't think it was, it never is going to change going online, but they did say that they did see an uptick in brick and mortar. So office right now, I think, is the one that's struggling, but we'll see how that turns around.
I got a question. Where's everyone going to live? They're going to live in multifamily, right? I mean, that's the beautiful thing about multifamily. Like, population's growing, right? They're not building any more of it. And regardless of what people are shopping or where they're working, they got to live somewhere, and that's the one thing that I love about multifamily is, if you're in the right areas and you're following the trends and doing all the things that we talked about, right? Sticking to your underwriting criterion, right? Like, having your metrics, right? Networking with the right people, finding the right sources of deals. Multifamily is a great space, and you can absolutely build generational wealth. I mean, when I was at the bank, I had so many customers and clients that came to this country with nothing or started with one building, right? Like all of us here on this call, we started with one building, and now they have hundreds of millions of dollars in real estate. And anybody listening can do it. And I just wanted to point that out because there are a lot of different asset classes, and the more sophisticated you get, the more it may be appropriate to look there. But multifamily isn't going anywhere. It's going to be here. It's been here and it's going to stay.
So let me just say this real quick. There's a bunch of people out on Clubhouse. A couple hands have been up. If people have comments or questions, you guys want to know something out on Clubhouse, back channel Moose, and he will get the questions answered. We've got a few minutes left. You guys got a couple minutes yet? We're running a little over,
We're
but
fine. Yeah.
Conversation's been great. If I got a question out here on Facebook. So if you're joining us live on Facebook and you have a question, get it in the chat because we'll be winding this thing down in the next few minutes. Welcome if you've been on Zoom with us. And if you are out on Clubhouse and you have a question, back channel Moose, and he'll get that question answered for you. Nolan asks, another one of my coaching clients, he's asking a question and he says, thoughts on development in place on low cap rate, existing cap rates. So he's asking, what about low cap rates? Thoughts about doing development on in place low cap rates. So I think what he's alluding to here, Nolan, correct me if I'm wrong, is he's just bought a piece of property that has a lot of land. He's going to build some new buildings on it. It's already a low in place cap rate on what's there, but he thinks that he's going to be able to create more additional value to it. And Nolan has got an interesting program going because he is going to be building some modular housing products.
Yeah.
So from a development standpoint, if anybody's doing some development, that's a guy to talk to because he's bringing that to place. So what do you think about in place low cap rates? I mean, I think it's a way of the market today. To answer that question, I just think that it is what it is. Hey, I put this deal in Florida under contract in August. We bought it at a 5 cap, maybe a 5.10 cap. Today, we're going to close it in 2 weeks. We had some glitches. Freddie ran out of money along the way, and we had to switch lenders. You guys know that whole deal at the end of the year. But we had some glitches along the way. We're finally going to close this thing in 2 weeks from now. So we're actually raising some capital on it. I think we could close it and flip out of it at like a 4.25. I mean, that's what the market's done, and not even raise a finger or do anything to it. Yeah. But I believe that it's a big value add. It's a heavy lift, and there'll be some merit there. So.
You bring up a good point though, Mike. One of the biggest deals, actually the biggest deal I ever did was an assignment. And for those of you that don't know what that is, when you put a piece of property under contract, you control it, right? And so it just so happened, I put this piece of property under contract. I didn't realize my partners had also executed 2 other contracts. So we could only take down 2 of them, right? And I said, I'm going forward with this contract anyway. And we ended up finding a buyer that was willing to pay us considerably more. It was a condo conversion in the city of Chicago. And, we made a boatload of money on that property. We never took possession of it. We actually assigned it. We put it under contract. We controlled it within 90 days. We'd assigned it to another buyer, and we made a profit on it. So, back to our point earlier about getting into action and taking advantage of opportunities, whatever they are. Listen, here's the reality we talked about earlier. None of us here on this call have a crystal ball. We don't know if the cap rate's going to go up or down. We don't know what's going to happen on Wall Street. We don't know what's going to happen on Main Street. However, if we have a plan and a strategy, and part of that is taking action and putting things under contract, and getting yourself into a position to leverage or to take advantage, that's really important. And one last thing I want to share with the group, wealthy people don't own anything. They control everything, right? I'll say that again. Wealthy people don't own anything. They control everything, right? And that goes to real estate too. They don't own the real estate themselves. They own it in trust typically, or LLCs or corporations. My point is, in real estate, you can actually profit by being in the right place at the right time and recognizing that situation and taking action. So, and I think we hit on these points throughout the whole show. So anyway, Mike, I just wanted to add that. I know we're getting long in the show, so it's really been great. Jim, Tim, it's great to see you guys. I want to network with both of you offline because you are local, and Tim, we got that connection with Stan Dubicki and the hockey, so we'll definitely have to connect.
Yeah. So
it was great seeing you guys.
Yeah, for sure. Real quick again, we this is Multifamily Unplugged. We're here every Saturday morning, 10 o'clock Central. We go live on Clubhouse, live on Facebook. Carl, let's just talk about this real quick. There's a bunch of people on this morning. Let's let people know we're going to change platforms here in the next couple of weeks. We'll be changing platforms, going to StreamYard. This is not a StreamYard commercial. It's a Multifamily Unplugged commercial. And we will be going live on multiple platforms off of StreamYard. I have found that StreamYard will give us the opportunity. We'll be able to go live on LinkedIn, live on Facebook, and live on YouTube. So anybody who gets their fix somewhere other than here or Facebook can join us there. So that'll take away from the component of having anybody else on our platform with us other than our guests. But we'll be live in those other places. So people keep that in mind. Watch the social media that comes out with that information as we start to make that change. Guys, any last closing thoughts, comments? Tell people how they get a hold of you if they want to pick your brain, talk multifamily, see what you're doing.
Yeah. Well, thank you guys, Mike and Moose, for having us on. It was a pleasure, and I look forward to continuing the conversation after this video and staying in touch with you guys. You can find us. We're 10 West Real Estate Group. That's 10westreg.com. 10 is numeric. You can find us out there. Tim Coleman, Jim Marzullo on LinkedIn. You can find us out there as well. Happy to hear from anybody after the show. I think the last thing I would leave for people, I don't know how many people are getting started in real estate or where they're at, but I would say this is a tough market, but keep going through the motions, right? And that's what we're doing right now. So, keep underwriting deals, keep at it, stay the course, don't get discouraged, right? I think that's what we're doing, and keep them going. And for people getting started, know your numbers and have a goal, right? And so you guys talk a lot about intention. I think it's easy to get distracted sometimes in this business, especially when you're searching and trying to find a deal, but stay focused. And, I love real estate. I could stay on all day and talk about it with you guys, but it's been a great experience. So thanks for having us.
Yeah, let's go out and buy some instead of,
Yeah, Mike and Moose, I appreciate the time too, as well, being on here. I don't know if my video came over or not, but I'm able to see you guys now. But yeah, like Jim said, here's another thing. I guess this is going back to my teaching background, right? You got to educate yourself on it. So if it's a good market, just learn, read, reach out to people who've done it before. I'm a big advocate of, everybody talks about, like YouTube and all this. It's like, you don't have to reinvent the wheel. There's people that have done this already. Reach out to them, talk to them. I mean, we enjoy talking real estate. Like I said, Jim and I are both passionate about it. So it's always good. So I appreciate you guys letting us be on there.
Yeah. So listen, here's what I think we should do, Carl. Let's keep Clubhouse going. There's a whole handful of people out on Clubhouse. Alvin, I'm going to go ahead and make you a moderator. Maybe you can handle this for a few minutes while Moose and I wrap this up over here. And then we'll.
Yeah, Mike, I'm a moderator too, Mike. So yeah, we can keep it open.
Okay. All right, good. So yeah, let's keep it open and kind of keep the conversation going out over there. So I'm going to go ahead and mute myself off of Clubhouse. I'm going to shut this room down. Hey, everybody, thanks for being here. Great to see everybody. Saturday morning multifamily unplugged. Moose and I are super excited about continuing this as we go into the new year. So looking forward for everybody being here, and however we can create value, add value to your network, to bring, we want to bring relative content every week, which we've been doing for the last year. So thanks.
And you're going to stop the recording, Mike, right?
Yeah, I'm going to stop the recording.
Hey, good morning. Well, I guess I'll step in for Mike while he finishes.